You know, when a major bank reports its earnings, it's not just about numbers on a page. It's really a health check for the entire economy. So today, we're going to put KeyCorp under the microscope and see what its upcoming report tells us about where things are headed in 2026.
So what is next for the economy? That's the big question, right? Well, KeyCorp's performance, which we'll see on January 20th, is a huge test. It's going to give us some powerful clues about everything from loan demand to how the average person is doing financially. Is it growth or is it a slowdown? Let's break it all down.
Okay, first things first. Let's meet the company at the very center of this story, KeyCorp. Because to really get why their results matter so much, you gotta understand who they are. KeyCorp, which you'll probably know better as KeyBank, is pretty much the classic Main Street USA kind of bank. We're talking 1,200 branches spread across 15 states. It is deeply, deeply woven into the fabric of local economies, serving everyone from small businesses to everyday savers. And that's exactly what makes it such a powerful barometer for the nation's financial health.
Now, for investors, there's one number that really jumps out, that dividend yield, sitting at about 3.5%. This is the cash that shareholders get paid right back into their pockets. It makes the bank's performance something they can literally feel in their portfolios. And believe me, that's a huge reason why so many people will be watching these results so closely.
All right, let's zoom out a little and look at the bigger picture. KeyCorp isn't just operating in a bubble. It's facing a massive test, one that's been shaped by the Fed's recent interest rate hikes, which, as you know, have completely changed the game for banks.
And this right here perfectly illustrates the central dilemma they're in. On one hand, yeah, higher interest rates mean banks can earn more profit on their loans. Awesome. But, and this is a big but, those same high rates can also slow down borrowing, cool off the economy, and make it riskier for people and businesses to pay those loans back. It's a real tightrope walk between growth and risk.
We can really break this whole challenge down into 4 key forces. First, you've got interest rates, the price of money. Second, loan demand, which tells us if the economy has an appetite for growth. Third is credit quality, basically the bank's report card on its borrowers. And finally, deposits. That's the fuel that makes a bank's lending engine run. These 4 things, they're going to decide KeyCorp's fate this quarter.
So, with the stage set, let's dive into the 2 competing stories that are going to shape how investors see these results. It's the classic showdown, optimism versus caution.
In one corner, you've got the bulls. They see opportunity, they see strength. And in the other corner, you have the bears, who are seeing risk and potential weakness. What's wild is that they'll be looking at the exact same data and come to completely different conclusions.
This slide just lays it out perfectly. The bulls, they're betting on stable interest rates, strong loan growth, and the bank getting more efficient. They see a really positive quarter ahead. But the bears, well, they're worried about a slowing economy, more people defaulting on loans, and intense competition for deposits, all of which could really squeeze profit.
So the bullish scenario, it's like this perfect trifecta of positive signs: strong loan growth, stable profit margins on those loans, and healthy income from fees. If all 3 of those cylinders are firing, it could be a really, really strong quarter for KeyCorp. The bear case, on the other hand, is all about the headwinds. You get a drop in loan demand, a rise in credit losses, and higher costs to keep depositors' money, and you could have a perfect storm that hits the bottom line hard.
So, when the report comes out, how can you, yes you, tell which side is winning the argument, the bull or the bear? Well, let's get you set up with a simple scorecard. We're going to focus on the 3 most important things to look for.
First up, net interest margin, or just NIM. Put simply, this is the difference between the interest a bank earns from its loans and the interest it pays out for deposits. A wider margin means higher profits. So if NIM is stable or growing, that is a huge positive signal. It's really the purest measure of how a bank's core business is doing.
Next up, you got to look at credit loss provisions. This is basically the bank's rainy day fund. It's the cash they're putting aside because they think some loans might go bad. So if you see this number rising, it's a big sign that the bank is getting more worried about the health of its customers and the economy as a whole.
And finally, there's loan growth. I mean, this is the engine of a bank's success. Simple as that. Without it, long-term growth is basically impossible because the bank isn't putting any more money to work. A slowdown here, that's a clear, flashing sign of a cooling economy. So keep a close eye on these 3 metrics.
But here's the thing. Beyond all the numbers from the last few months, there's one final element that might just be the most important clue of all. And it's not about what just happened, it's about what's going to happen next.
This quote really hits the nail on the head. What the company's leadership says about the future can actually matter more than the results from the past.
See, investors are always looking ahead, and the company's outlook is what sets the tone for the entire year.
This is what we call forward guidance. It's the company's own official forecast. Are they feeling optimistic about lending in 2026? Do they see economic storm clouds on the horizon? An upbeat forecast can send a stock flying, even on so-so results, while a cautious warning can sink it, no matter how good the past quarter was. And that really brings us to our final thought here. When KeyCorp speaks, its guidance won't just be a forecast for its own business. It's going to be a reflection of what thousands of its business and consumer clients are planning, feeling, and spending. So the real question is, will its report be like a crystal ball, showing us a clear and prosperous 2026, or will it signal fog and uncertainty up ahead? We are all going to find out on January 20th.